Thanks and welcome, everyone. Once again, this is Brian Hartstein, your host. I'm the Director of Corporate Development here at Bayntree Wealth Advisors and also head of the 401k advisory team, which basically works with all the 401k plans that we help advise and work with, not only from the participant level, but also the trustee level. And so this is the last in 2018 of our quarterly educational webinars. It's hard to believe that we're at the end of the year already. So I hope everyone had a wonderful Thanksgiving holiday and looking forward to a great holiday season and a close of the year. It's just hard to believe that the year's gone by so fast. So one of the things that we always like to do at the end of the year, and again, we always tackle a variety of topics throughout the year, but we always try to hit some year-end planning, things that you might be able to look at and do before we get to the close of the year, and also setting up maybe some financial goals and trying to prepare yourself for the beginning of the new year. So it's one topic that we love, but again, we do 4 topics a year, 1 per quarter. So if there are any financial topics or anything that's of interest to you, please contact us and let us know, because we're happy to try to tackle those topics and help educate people better if there's enough of a demand for those things. So we try to kind of hit what we think is pertinent here and then, try to expand upon that. Obviously, if anybody has individual questions, they're certainly welcome to contact us here at Bayntree Wealth Advisors. So real quick, when we get started, we're not going to take up too much time today, but I think we're going to go over some very, very important and I think valuable piece of information for you. So again, here is part of the Bayntree team that you'll see working with you as a participant in the 401k plan. Again, myself, Brian Hartstein. We've got Chris Roger. He's here with me today, financial advisor, also known here as the man with the plan, and works with all of our 401k participants in helping them in a variety of topical areas, whether it's just questions about financial planning, building a basic plan, helping align your account, risk tolerance. All those areas is an incredible knowledge base in, and does a great job working with our participants. And then we have Brenda Blanco and Jessica Amaya as well. So this is kind of your dedicated team here at Bayntree. And as a participant in the 401k plan, again, there's no cost whatsoever for you to reach out to us, whether it's through email, whether it's through phone. You can always stop in our office. We're local here in Scottsdale, and we are here to help. It's just one of the benefits that you have as a participant in the 401k plans that we work with. So once again, I'm sure you're familiar with some of the people here, but we always like to identify the valuable members of our team. So real quick, just a quick overview and what we're looking at in terms of not only cleaning up your planning for 2018, but maybe getting a head start on your planning for 2019. So we've got some other topics we're going to attack a little later in the webinar, but one thing we always try to talk about is, if you can, there's only 1 or 2 payroll periods left, but maybe increasing or trying to max out your 401k plan contributions if possible. There's a variety of reasons people try to step up contributions at the end of the year, whether it's through your traditional account or if your plan has a Roth option as well. So if you can, we always think it's a good idea to try to beef those up for the last couple pay periods. Another thing that we think is really beneficial, and again, we don't necessarily work on, but we think it's great advice to look at your health insurance, and if you have them, health savings accounts, because you might have open enrollment occurring shortly at the end of the year or in the early part of 2019. So always review your health insurance, look at the types of plan you're in, the deductibles, make sure that they meet your goals for what you think you're going to need in the coming year, and your health savings account. We always think it's a wonderful planning tool so that if people can make contributions or max it out, it's just an incredible planning tool that you can use for now and the future. If you have questions about that, we're certainly here to help answer those as well. Flexible spending balance and flexible spending accounts. Again, not everybody has those, but if you do, there were some changes in the tax law that kind of went away from what we call the use it or lose it approach. But that had to be done at the employer level. So for many people, you still have what we call that use it or lose it. So if you have a flexible spending account and you still have a balance, you definitely want to know whether you need to use the monies in that account this year, because they might go away and start over again in 2019. Now, again, with the tax law change, they might not, but it's a really good idea to make sure you understand, if you have an FSA, how those accounts work. And then consider maybe some charitable donations and plan giving. One of the things that we like to talk about a lot here is there's certain types of donations that you can make at the end of the year where you get certain credits at the state level. And it's a way to help direct your tax dollars so that you decide where those monies are spent, whether it's for the working poor or some great charitable organizations here in the state, and not let the state dictate where your tax dollars are spent. So if you have questions about those, you can always go to our website or call us. We're happy to walk through those with you, but we think it's just a wonderful way to help give back and also take advantage of some good tax advantages. And so if you want to look at like a head start planning for 2019, Chris will tell you a few things that we can look at to help you in your plan.
Yeah, absolutely. Thanks, Brian. And when we look out towards 2019, I think a lot of people have noticed that some of the recent volatility in the market. So what we always focus on, regardless of volatility, is more on developing a full plan. Because if you have a full plan set in place, then a short-term volatile time isn't really going to cause you to make any emotional decisions. So whether that's determining how much to put inside of your 401ks or Roth IRAs or any other sort of investment accounts, helping to develop the cornerstone of a financial plan. If you do not have one set in place for this year, that could definitely be a good starting point for 2019. And then discussing, if you're approaching retirement or am I on track for retirement, whether you're younger and starting out or if you're a seasoned employee, you can look at, am I ready or on track? And that could be simply just by giving us a call. I know John Hancock has some helpful tools to make sure that you're on track with retirement. And
or Principal is the other platform which we utilize, and they have some great tools as well.
Yep. And the biggest thing to make sure that you're on track for your retirement is to be able to set goals, whether they're big or small, that as long as you're getting something in motion and working towards that, whether it's I want to add another 2% to my 401k, or I want my 401k balance to be X, or whatever the case may be, having those goals set in place where you know they are achievable keeps you accountable to your plan moving forward.
That's great. So let's take a look at a couple topics that we wanted to hit upon. And one, obviously, we've talked about this in the past, but because of the recent, what we see volatility in the markets, and we do get questions of people that are concerned. And again, when you're looking at your 401k plan, it's a much longer time horizon unless you're very close to retirement. But we always want people to understand the risk they're taking inside their account and to make sure that they're comfortable with that risk, whether it's now or in the future. So, we always like to use our pyramid, what we call our risk review pyramid, which gives you an idea of how risky things are. Maybe green means safe, blue is somewhere middle of the road, and red might be riskier. And again, not all investors are created equally, and some people prefer more risk, some prefer less. Some people who might or should be taking on more risk aren't real comfortable with it, and there's reasons why they might want to become more comfortable or have better education understanding of what you can do in your account to help optimize it. So I know Chris works a lot, especially using some of our risk diagnostic tools here to help individuals determine not only what their risk tolerance is, but what might be appropriate in their account. So again, like Chris said, there's volatility in the markets. And the one thing we can always tell you with certainty is there's always going to be volatility at one point, sooner or later. It's not a bad thing. It actually works for you inside a 401k because you're making contributions on a per pay period basis. So you're going to make contributions to your account and buy in whatever you've invested in the market, whether the markets are down or they're up. But over time, it's going to work for your benefit. So we always want people to understand what their risk tolerance is, and we're more than welcome and happy to do a risk review with anybody who wants to look at that for themselves. Plan contributions. Chris, you might want to walk through, plan contributions, and not everybody has a company match, but the ones that do.
Yeah, if one of the basic questions we get right off the bat with any 401k plan is, hey, how much should I put into the 401k? And if your company does offer a match, our answer 99% of the time is going to be, hey, just put in enough to get the company match. And even if you don't invest it in the market, you're getting free money that your company is contributing to you for your retirement account. So if you can, you always want to try to take advantage of the company match, and every company plan is a little bit different. Now, one of the other things that we touched on a little earlier was looking out towards 2019 for planning and developing a full plan. Big cornerstone of most individuals' retirement plans are their 401ks. So what's a good way to build that up? A good rule of thumb, number one, put enough in in order to get the company match. But if you also can save more on top of that, 10% is definitely a good starting point of your gross salary to put into the 401k. And if you are in a position where you happen to receive a pay raise year over year, one of the things that we always do is recommend to set up when you get those pay raises to increase your contribution to the 401k. So let's say, for example, you get a 3% pay raise. Maybe you put one extra to the 401k and two more in your pocket today. Or maybe you do two more into the 401k and one in your pocket today. But either way, when you get that raise, if you set it up for it to automatically go into your retirement plan, that's money that you're not going to miss. So easiest way to save for retirement is to just set it up to automatically happen. So that way you know it's going to be there regardless, and you don't have to do anything to make sure money's in your pocket and then you have to see it go into a retirement account. It's always easiest to just set it up on autopilot, have everything done automatically for you. And as you continue to work and progress and save throughout retirement, you can look up and say, hey, I have a lot more than 3 years, 5 years ago. And Brian and I have heard people say that they haven't looked at their 401k for 10 or more years. So always want to try to put in as much as you can, at least minimum for the company match to get the free money. And if you can, try to put in up to 10% of your gross pay.
So we also get a lot of questions, and we'd like to talk at the end of the year because people are usually doing a lot of cleanup at the end of the year in a variety of areas on consolidating accounts. So we get questions on, hey, I've got an old 401k with a former employer. What should I do with that? Or if I've got multiple other accounts. Now, we always say that, there's no cookie cutter answer. And for some people, it's better to have multiple accounts. However, for most, simpler is usually better. Number one, it's from an ease of management. When you're trying to manage and have an asset allocation strategy and you've got multiple accounts, then you have to find ways so that you can manage them both globally, all at once, and also individually. Now, we have some technology that we utilize here for clients that lets you do that. And as a participant, you are more than happy to call us and we can kind of walk you through that. But in general, it's better to unify your accounts to have more of a unified asset allocation strategy. And then you're also not worried about an account, gosh, there's one out there, I haven't seen a statement in a while, what do I do? And again, that creates less time you're going to spend on it, whether it's keeping track of passwords, if you're getting quarterly statements, companies change and move and trying to keep those updated. So again, you're just trying to simplify your life and spend less time on these things so you have more time for your family or to work or do whatever you want to do to help enjoy yourself. And again, one of the most important things is the beneficiary designation. Each account has a designation for a beneficiary in case something happens to you that someone else will receive those. You'd be surprised at how many times we hear that people have not looked or updated their beneficiary designation since they set up the account, and that could be 10, 15, 20 years ago. So again, if you have simplified your accounts, then you only have to worry about one or two maybe beneficiary designations and looking at updating those. So again, that's why we always think simpler is better as a general rule of thumb. But of course, there's reasons maybe that people have and should have multiple accounts. And one of the things that we do here is we try to help you, if you're one of those people, try to find the best option to meet your planning needs. But it's a very common question, and we get it all the time. And again, no cookie cutter answer, but we just try to say simpler is better. So if you want help consolidating accounts, if you have questions about a prior rollover or prior 401k account with a former employer and whether it makes sense to do a rollover or not, please reach out to us here. We're happy to walk through those options with you. All right, updating beneficiaries. Chris is going to kind of jump into why this is important.
Yeah, so Brian touched on it a little bit in the prior slide, but when you're doing your year-end review on your different sort of investment accounts and retirement plans, you always want to make sure that the beneficiary is up to date. Most important reason why the beneficiary is so crucial, because anybody that you have listed on your beneficiary is who is going to receive the money. So let's say, for example, you were married and went through a divorce and you're separated now, and then you got remarried. Well, if you pass away, whoever is listed, if you still have the ex-spouse listed as your beneficiary, your current wife's not going to be too happy, or your current husband's not going to be too happy, because that money's going to go to your ex-spouse. So the beneficiary form on any of your investment accounts are going to trump any sort of estate plan, trust, or will that you have set up elsewhere, because the John Hancock or the principal platform or any sort of insurance company down the road, they don't know that you have a will. They don't know that you have these other types of estate plans set in place. They just know what's on their form. So whoever is listed on your beneficiary is who's going to receive the funds for that account, regardless of any other estate planning that you've had. So if you've had children, grandchildren, divorced, remarried, all of these kind of things where you're going through transitions, it's always very imperative to make sure that you take the couple minutes to review who your beneficiary is. If you have questions on how that process works, that's where you can reach out to us directly and we can talk and give you some more specific type of advice. But very easy put, make sure that you review it at least once every other year. That way you know if anything does happen to you, the right person is receiving your funds.
Right. And so and that's the biggest question we get from people is that, well, I've got a will. I don't really need to worry about my beneficiary designation. And just like Chris said, that's not true. You may have a will, but whatever beneficiary designation is on your account, that is who will receive it. And so if you have a primary and a contingent, understanding those is important, because the primary is the person who is going to receive the account first and foremost if you're not around and you've passed away. If that primary person predeceases you and they're gone before you and you pass away, the contingent is the person that will, or persons will receive it next. So primary would be the first, contingent is the second. So it's also important to make sure your contingent beneficiaries are set up properly, because things happen and there's our cases where we have the primaries already passed away, and then we want to make sure that it's going to go to the right people afterwards that you care about and who should be receiving the accounts. So very important, won't take very long to update. We, like Chris said, always check it at least once every couple of years. It'll only take a few minutes, but believe me, it can save you a lot of heartache down the road. So let's talk a little bit about goal setting for 2019. And these are some things that we think are just great rules of thumb to look at and saying, hey, what should I look at and trying to do in 2019 that's going to help me or help my family? And again, everybody's a little bit different, but the one thing we love about goals is, like Chris said, they keep you on track and they keep you accountable. Maybe you set them a little high so you don't always achieve them, but they let you have something to work for the given year, and then you can reset them for the next year. Some people even have 1-year goals and 5-year goals. So they're great to have. Again, they keep you accountable and they keep you on track. And the one that we always like to talk about is building up your emergency fund. Maybe have $1,000 to $2,000 in an account put away just in case something pops up that you were not ready for. And you'd be surprised at how many people don't have an emergency fund available. So we think that's just very important to have. And again, then we look at on the third bullet point here, save enough for 3 to 6 months of monthly expenses besides your emergency fund. So if something happened, you were out of work, you didn't have disability, or if you just needed to dip into that, you've got enough put away for at least 3 to 6 months of monthly expenses.
Yeah, and I want to point out one of the important factors of the first 2 bullet points. The first bullet point is build up your emergency fund. And Brian and I have seen it where individuals say, well, I just want to get out of debt first. And if it's credit card debt, and let's say you pay off the credit card debt, but then you have no emergency fund, and then an emergency happens, you're just going to put it right back on the credit card, right? So you're just kind of throwing dirt back in the hole. So that's why we always like to say, if you can, you want to try to build those cash reserves for you in case of an emergency. So that way, if anything comes up, you're not adding more fuel to the fire with any outstanding debts that you may have. So I think the importance of having reserves set aside, which are there just strictly for emergencies, very critical component to your financial plan. And then once you have enough emergency funds set aside, that's where you can look at increasing or potentially maxing out your 401k. And then once you can max out your 401k, or you add a comfortable amount to your 401k, that's where you can look at this last bullet point here of, hey, well, let's start building a plan. I have X amount left over every month, and I don't want to just have it sit at the bank, right? Because you have that emergency fund built up, you want to try to have those extra funds coming in working for you for the future. So big part of setting goals is making sure that you're in a position to save more for the future and help eliminating some of that debt. And it just makes everything that much easier for you when you have that peace of mind as well.
Yeah, and just to follow up on Chris's points about the reduction of debt, what we always think is a good rule of thumb is that you try to knock out the smallest amount of debt first. Now, obviously, if you have a piece of debt that has a very, very high rate of interest on it, you might want to look at that piece as well. But what's great about reducing debt is when it's gone. So we always say, look, tackle the smallest one first, and then all of a sudden, you've paid it off, and it's great. And it's off your plate. You can move on to the next one. So we kind of call it snowballing debt. Take out the smallest ones first and then move into the bigger ones, because there's nothing that is more disheartening than when you sit in there and you're paying down debt, you don't feel like you're getting anywhere. And it really reduces your motivation to get rid of it. And then you end up carrying it for a long time, and all you're really doing is accruing interest. So we always say, look, if you can, try to knock out the smallest pieces of debt first and then work your way up. And if you have two pieces of debt and you're paying the same interest rate on each one of them, then try to take out the smallest one first. And that way you really feel like you're making headway and you feel good when you see it gone. So, again, we also get a lot of questions on, hey, should I pay down debt or should I increase my 401k contribution? That's an interesting question. Again, I'm not going to give you a cookie cutter answer for that. If you're a person that has that situation facing you, please reach out and call us. We'd like to walk through the specifics of it with you before we actually give you an answer and try to find the best way for you to kind of attack that problem. But the most important thing that we see, obviously the first four bullet points are very important, is build a plan.
Yep, absolutely.
And one of the things that we do here is we help individuals build a plan. And again, as participants in 401k plans that we help service, you can certainly call us. There's no charge for doing that. And we'll certainly help you try to build a basic financial plan so that you've got some structure, you've got some things to work towards, and it'll keep you accountable and keep you on track so that when you do get to a point when you want to retire, you'll be able to look back and say, wow, I was able to build up so many of these different assets, reduce my debt, and put myself and my family in such a much better position than I had if I just kind of, just did it without really a plan, without a structure in place. We just think it's so important. And it's one of the things here that we can certainly help with. And we just urge all individuals, if you're not doing it with us, go do it on your own. There's goal setting, like Chris said, on the 401k platform, whether it's with Principal or John Hancock, you can utilize that. But do something, because I guarantee you're going to be a lot more successful with a plan than without a plan.
Yeah, absolutely. And one of the things.
You're going to touch over there. Great.
So if you do have questions on your 401k or any outside planning, that's where you can reach out to us directly. If you're not sure what you're comfortable with in regards to the amount of risk you want to take inside of your 401k, you can head to our website, Bayntree.com, and there's a great software that we use called Riskalyze. Riskalyze is a technology that helps to emotionally weigh out how you feel about risk. So a 1 is going to be more conservative and a 99 is going to be more aggressive. And it tries to measure two different pain points of, number 1, being aggressive and seeing your account balance go down, or number 2, being very conservative and a great year like last year, not participating in the gain, and where's really that sweet spot for you. So if you're unsure on what you're comfortable with the amount of risk that you're taking, especially with the recent volatility, I would highly recommend go through the Riskalyze questionnaire. It's about 7 questions. There's no right or wrong answers, but then that way you have a good idea on what your comfort zone is. And part of what we do here at Bayntree is helping clients with comprehensive financial planning, whether you're just getting started and you want to know, where you should be allocating funds or how much funds you should be allocating to certain pieces, or if you're approaching retirement and you're saying, hey, I'm looking to potentially slow down from work, or I want to retire in 5 to 10 years and I have my 401k, this account and that account, but there's no real game plan on here's my growth account, or here's my safe account, or here's my risky account. Part of what we help participants in the 401k plan do is just offer a second opinion and help you get closer to those retirement goals. So tax planning, social security planning, 401k allocation, any of those things that you may have questions on, that's really where we live and breathe, and that's where we want to be able to help you.
So we just like to say at this point that we thank you for letting us help educate you and spending time with us. That's what we're here for. We hope you found some of the education that we've delivered over the past year valuable. And again, if there's any topics that anyone would like to see going forward, please feel free to call or email us, and we'd certainly be willing to tackle any and all topics. We love input. We just want to make sure that it's pertinent to our participants and they find it of value. So we're looking forward to a very successful and prosperous 2019. I hope you are as well, and we wish you a wonderful and happy holiday season, and hopefully we'll be in touch soon. So thanks. Take care.